Welcome back. You're watching The Money Show on ET Now. Well, if you've been, an ardent follower of The Money Show, you'll know we discussed a concept called as factor investing, in this previous month. But guess what? Here's a fund that employs not one, but two factors when considering investing. This is the latest from the stable of ICICI Prudential Mutual Fund. It's the ICICI Prudential Alpha Low Volatility 30 ETF Fund of Fund. So what exactly is the thesis? What's the objective of this fund? To understand all of it, I have with me Chintan Haria of ICICI Prudential. Chintan, great to have you back with us on The Money Show. Always a pleasure speaking with you. Let's start off first by understanding a little bit about this fund. What exactly is it? Where will it invest?
Yeah, so it's in the series of investing into smart beta factor-based funds, as you already highlighted, and I think we did one show on that specifically last month. We believe that investors' increased diversification requirements and also their deeper understanding of the markets has made factor-based investing a popular way of investing. And within the factor-based investing, we launched the first single factor based ETF in 2017, which is the ICICI Prudential Low Vol 30 ETF. And in that series, last year in August, we launched the other ETF, which was India's first multi-factor smart beta ETF, which is the ICICI Prudential Alpha Low Vol 30 ETF, which is based on two factors, alpha and low vol. This was in August 2020. And now we are happy to launch the fund of fund, which invests into the Alpha Low Vol ETF. Essentially, it will enable those investors who do not have a demat or a trading account to invest in the multi-factor smart beta ETF through the fund of fund.
Okay, so alpha and low volatility, these are the two factors that you will consider when picking stocks for this fund. So let's first talk about alpha. What exactly is that? And how do you sort of follow that factor when creating this alpha low volatility 30 fund?
Sure. So as you know, this is a passive fund. It will be tracking the passive Alpha Low Vol 30 index. And as part of the index construction or methodology, first the universe has decided the universe is top 100 stocks which are in large cap and the mid cap 50 names. So essentially it's a 150 stock universe from which you will be selecting 30 stocks. Now for selection of 30 stocks, like you mentioned, Mubina, there will be two factors, which is alpha and low vol. How those two factors will be applied, I'll come to later, but I'll just explain what alpha means and what low volatility means. Alpha means essentially those stocks which have delivered better returns than the benchmark. So over the last 6 months and 12 months, the stocks which have delivered better returns than the benchmark are known as stocks which have generated alpha. So you rank those stocks and you basically pick the stocks, or you give the scores to the stocks which have got the highest alpha. In extension to that, you have low volatility as well as the other factor. And low volatility is essentially, in simple terms, stability. So those stocks which have been stable over the last 1 year as calculated by the standard deviation statistical measure. I won't go into the statistics, of course, it's probably too difficult to explain. But from a simple common language, if I have to use, those stocks which have been more stable over the last 1 year are considered to be low volatile stocks. And in combination, you may ask, how does the combination work? You basically give scores to both these factors, and then the stocks, the 30 stocks which have the highest score based on both these factors are selected to form the alpha low vol. So in some sense, it is basically those stocks which have given returns but have been stable as well. So growth with stability is what you would get in the particular ETF, given these two factors, which is alpha and low volatility.
All right. So basically, Chintan, there already is obviously the Nifty Alpha Low Volatility 30 Index that's there. So will, the fund of fund essentially be aping that, considering the fact that it's a passive fund, it's an ETF. So will you be essentially aping this and, sort of rebalancing your fund as well based on the rebalancing as in when it happens in the benchmark index?
Yes. So the fund of fund, which is the NFO, which is open till 15th of September. And since it's being an open-ended fund, it will open for repurchase and redemptions also as we move along. It basically allows, the fund of fund will invest in the ETF, which ultimately tracks the index. So it is just let's say a structure wherein whatever money the investors put in the fund of fund, that will get ultimately invested in the ETF, which is already there since August 2022. And the ETF in turn will basically do the rebalancing and investing in the proportion that is there or track the Nifty Alpha Low Vol 30 index. So in a sense, from an investor perspective, it gives the convenience of basically investing in the fund of fund where you don't need a demat or a trading account, which you would have otherwise needed in the ETF. And the ultimate investments or the ultimate, let's say the tracking would happen of the Nifty Alpha Low Vol 30 index.
Let's talk then about the potential of these two factors, alpha and low volatility. Coming together, if someone has followed this investment style, or let's say if they have invested in this Nifty Alpha Low Vol 30 index, how has this index performed versus, say, a Nifty 50 or a Nifty 200? If you could share that with us during different market cycles that we've seen in, say, the last 5-6 years.
Sure. So the numbers are like this, that if I take the last 12 calendar years, including 2021, 9 out of 12 calendar years, this particular smart beta strategy, the index has been able to beat the Nifty 50. And over the last 10 years, if we see, the returns from the index are better. However, more than the past returns, what I would like to also suggest to the investors is that generally, whenever we are making investments, we need basically these two attributes. One is we're looking for better returns, and second is we're looking for stability in terms of the stocks. We don't want necessarily those stocks which are too volatile or give returns and then go off the radar. So this combination of having the top 150 names in mid cap, so 100 names in large cap, 50 names in mid cap, having a 5% cap at each rebalancing which happens every 6 months, and the underlying stocks having derivatives. All of this is essentially ensuring that the risk-adjusted returns for the investor for the long run is better. And as part of that, having the alpha and low vol factor as a combination has worked well in the past, and we truly believe that for long-term investors as a strategic allocation, this is a good product. It's not meant to be a tactical allocation product, but the ICICI Prudential Alpha Low Vol 30 ETF or its fund of fund, both, depending on which investor wants to invest in the ETF or the fund of fund, are good long-term allocations to participate in the two factors, which we believe are very good fit for investors for the long run.
Right now, Chintan, the market is at record high levels. The Nifty and, even the mid and the small caps, they're all rallying. Many are saying that, okay, brace yourselves, there's going to be a correction, so on and so forth. But I think so far the market has sort of defied any bear call, that the market may have put forward. So in such a situation, and the construct of the market as we are seeing, the macros, etc., what makes you think that this alpha low vol factors would, do well, would continue to deliver the alpha as the name suggests over the benchmarks and, the Nifty, etc.?
So the first aspect of it is essentially the market levels. More than the market levels, we've always been at ICICI Prudential Asset Management Company advocates of ensuring that you have your asset allocation mix right, basis your risk profile. So once you've decided on your asset allocation and based on the responsibilities, the wealth that you already have and your recurring income, if there is space for adding to equities, or if you already have certain investments in direct equities where you have made good money and you want to relook at it, reshuffle it, and you like these two factors, then you may want to allocate it as part of your equity allocation. So it is clear that this is part of your equity allocation. From a timing perspective, you are right that the markets have rallied very sharply from March 2020. But if we look at the longer term horizon from an Indian equity perspective, if India has to grow from $3 trillion to $5 trillion, it will get reflected in the performance of the companies and the corporates. And if the investors' asset allocation allows participation in equities, then this becomes a good tool. The two factors, which is alpha and low vol, become a good tool to ensure that you are not only capturing those stocks which are delivering returns, but also those which have an inbuilt stability in it. So it's not the product wherein it's the most aggressive product because it has an inbuilt stability feature around it. It being part of equity, it will always be invested in equity, and hence it should be part of your equity allocation. And if the market does provide an opportunity because of cyclical reasons or global reasons for a correction, you may want to invest more and allocate more to either this product or in general to equities, because the next 3 years, 5 years, if we look at it from a inflation perspective, there is an allocation to equities which Indians have to do. And as part of that allocation, this will fit in well, given that it has an inbuilt stability mechanism within the two factors.
How do you, Chintan, look at the risk factor? You mentioned that it's a low vol. So obviously, you look at the stocks that have not really seen too many gyrations in movement. So that essentially is low volatility. And whenever there's less volatility, it means the risk as well is relatively low. However, your riskometer, you've put the needle at very high. So if you could explain that.
Yeah, so it being a pure equity fund, the riskometer will be at very high. So all equity schemes will have a high riskometer because ultimately it will have the equity risk. But like you said, that within that, the two factors, one is returns, or let's say growth of stocks, and the other is stability. When you combine these two, you're basically getting, in some sense, the sweet spot in terms of returns and stability. And so from our perspective, as part of your equity allocation, and I reiterate, as part of your equity allocation, this is a good product for the long term. It's not meant to be a tactical product. And hence, it carries the equity risk. But then that's where if you want to basically make returns which are slightly higher relative to, let's say, inflation or in line with inflation, equities have proven to be that asset class in the past. And while the starting point today is not the lowest, ideally the starting point is March 2020, and those ideal conditions, how many of us were actually able to invest? Hence, having a stable approach to investing, having the asset allocation right, and more importantly, if there is a correction, investing more to participate in the upside. That's how I would see investors benefiting from this particular product for the long run.
Okay, I know you briefly covered it, Chintan, but just to sort of wrap up, the entire conversation for our viewers watching, who are interested in what you're offering, this whole factor-based investing strategy has really caught a lot of attention. We've seen outperformance as well in factor-based investing. So what would be the suitability? What should be the individual's time horizon and risk factor when they consider putting their money in this fund, in this NFO?
Sure. So first thing is this risk factor. It being an equity scheme, it should be part and it should be treated as part of the investor's equity allocation. As part of the equity allocation, we generally say the longer you keep, the better it is. And now, along with that, if you keep more, let's say more than 3 years horizon is a given where we are in terms of markets. But beyond 3 years horizon, also, I would say that if there is a chance and the market does provide any corrections, you need to be able to have the ability to invest more as well. So from a suitability perspective, given that it is a large capish universe with a limited universe of 150 stocks, 100 being large cap, 50 being mid cap, and it has an inbuilt safety mechanism of buying those stocks which are low volatile. And if you look at the overall index construct also, today it is 40%, I think, around in consumer names and about 20% in information technology. These sectors and all, of course, will keep changing as the markets move along, as the winners keep along, changing along. But from an investor perspective, we believe this is a good fit in the current market conditions as part of the equity portfolio. So if you already have made money in direct investing or in funds which are more cyclical or which are, let's say, more aggressive, then this is a good switch opportunity also for those investors who are looking at investment avenues within equity, which may be less volatile and fit their or suit their investment needs. Thank you.
Chintan, it was great having you with us. Thanks so much for joining in and, just explaining and describing the latest NFO, once again from, the factor-based investing stable presented by ICICI Prudential Mutual Fund. I think the NFO is open till tomorrow, so you have time between today and tomorrow to subscribe to it if you're interested. And on that note, we're going to take a very short break. Be right back with more on The Money Show.